Good afternoon, Alex, here with Morgan for a midday check-in. We told you what to watch this morning. Let's see how it's playing out.
It is definitely playing out, just maybe not how anyone's textbook would have predicted.
That is putting it mildly.
Mhm.
So let's just set the stage. It's 12 p.m. Eastern. We called this morning a CPI day.
Right.
And usually there's a script for that. You get the number, the market picks a direction.
Yeah.
But today,
Mm-hmm.
it feels like that script has been completely shredded.
Oh, absolutely. The data's out, the prints are in, and now the market is in this really awkward sort of grinding phase. It's trying to digest what it just saw.
And if you're just looking at your screen, you're seeing choppy tape, no clear direction at all.
It's that, that dangerous kind of quiet. The algo's fired the second the data hit. We all saw that.
Yep, the initial spasms.
Exactly. But now the humans are stepping back in, staring at the screens, and just trying to figure out if the last 6 months of positioning just got completely invalidated.
And here's the vibe check, because this is where it gets weird. You look at the futures, ES, and Q, they're basically flat.
0.0%.
You'd think nothing happened. But then you look under the hood, and the VIX is sitting above 20. It's at 21.
And that's the disconnect. That's the crucial part. It's not panic selling, not yet anyway. But a VIX over 20 tells you the market is on high alert.
It feels fragile.
Very. Traders are paying up for protection. They're buying puts because they know this digestion phase can turn into active selling really fast if the narrative breaks.
It's like the entire market is just holding its breath.
Yeah.
And to get why, we have to go back to that big data drop at 10:15 a.m. Eastern, the inflation rate. We knew it would be a big deal, but I don't think anyone saw this number coming.
No, this wasn't just a miss. This was more like a regime shock.
Okay, so let's run through the scoreboard real quick before we tear that number apart. Equities are flat, as we said. But the real story, the real violence, is in rates. The 10-year Treasury yield is at 4.04%.
And the 2-year is at 3.40%.
That is a massive steepening of the curve.
We usually talk in basis points. Today feels like we're talking about a structural shift.
And then there's commodities and currencies. Gold is just getting hammered, down to 3.3%. And the euro. Okay, we have to spend some real time on this later, but euro futures are down over 20%.
20%. That isn't a slide. That's a dislocation. That's something breaking. You only see that when a currency peg breaks or, a government is in serious trouble.
So let's not bury the lead. We have to unpack this macro deep dive, and it all starts with that inflation print at 10:15. Walk us through it. The headline number looks, well, terrifying.
Okay, so the market was completely set up for a pretty standard inflationary world. The estimate for month-over-month inflation for January was a positive 0.5%.
Right. Normal. A slightly hot economy. Prices nudge up.
Exactly. Business as usual. The Fed fights it. We move on. Instead, what we got was negative 1.7%.
Negative 1.7. Just want to pause on that.
Yay.
Because usually on this show, when inflation comes down, that's a good thing. We say, great, soft landing achieved.
Yeah.
But this feels very different.
It feels different because of the magnitude of it. It's the difference between disinflation, which is prices going up more slowly, and actual deflation, which is prices crashing. If inflation misses by 0.1%, that's a cool down. When it drops 1.7% in a single month, that's a sudden grinding stop.
So this isn't like groceries getting a little cheaper. This is the gears of the economy seizing up.
Precisely. A drop this large suggests a demand shock. It means the consumer just slammed on the brakes. This isn't a soft landing. It's more like the brakes were hit way too hard, and now we're worried about the fallout.
Which is why the market isn't cheering. It's terrified of what caused that number.
Deflation is so much harder for central banks to fight than inflation is. You can't force people to spend money.
If they think it'll be cheaper tomorrow, yeah.
Right. It creates a spiral. And all that anxiety seems to be backed up by the sentiment data we got at 10 a.m.
No, it was not a ray of sunshine. Economic sentiment for February, it missed big. Came in at 58.3 versus an estimate of 65.8.
And the ZEW economic sentiment also missed. It just paints this picture of a consumer and an investor class that's losing confidence and fast.
Now, to be fair, the ZEW Current Conditions number, it actually beat estimates. Slightly.
You have to be so careful with a beat like that, though. The number was negative 65.9.
Okay, so less terrible than we thought is not the same as good.
Exactly. When your good news is that things are still deeply negative, just slightly less so than feared, That's a tough environment.
So let's connect the dots here, because this is where it gets confusing for me. We have this massive deflationary data, gloomy sentiment. But the 10-year yield is up. It's at 4.04%. Shouldn't yields go down if the economy's crashing?
This is the so what of the entire morning. It's the most complex signal we're getting.
Right.
The curve is steepening. So you have the 2-year yield that's anchored down at 3.4% because traders think the Fed has to cut rates immediately to fight this deflation. But the long end, the 10-year, is repricing higher.
What is that telling us? What is the big money thinking?
The bond market is looking past today's crash. It's a reflation trade signal. It's saying the central banks are about to panic. They believe the Fed is going to have to print so much money, or the government will have to issue so much debt to fix this deflationary hole that it will eventually cause massive inflation down the road.
So the terrible news today guarantees a fire hose of stimulus tomorrow, which steepens the curve.
That's the bet. It's pricing in an inflationary response to a deflationary shock. And that is a very confusing place for stocks to be.
Yeah, it's like the bond market is playing 4D chess and the stocks market is just trying to figure out checkers.
Well said.
And while equities are confused, the currency market has made up its mind. Let's go back to that euro crash.
It's ugly. I'm looking at the 6E, the euro futures contract. It is down 20.21% to 1.18.
A 20% move in a single session. For a major currency, that's not just volatility, that's a liquidity event. That is something breaking.
It is. This is the dollar just acting like a wrecking ball. Everyone is flooding into the US dollar, abandoning the euro, probably because of that deflationary shock we're seeing.
Okay, so for the average investor listening, the person who just has stocks in their 401k, why should they care if the euro collapses?
3 big reasons. First, earnings. You own a big U.S. company, they sell stuff in Europe. If the euro collapses 20%, all those European earnings are worth 20% less when they bring them back home. It crushes S&P 500 profits.
The strong dollar problem.
Second, emerging markets. When the dollar rips higher like this, it puts massive pressure on any country or company that has debt in dollars. It sucks liquidity out of the entire global system.
And the third reason,
Commodities. Just look at gold.
yeah, down 3.3%. It's a heavy hit for a so-called safe haven.
Because gold is also an anti-dollar trade. If the dollar is this strong, gold gets sold. Sometimes it's just to raise cash for a margin call somewhere else.
And crude oil's feeling it too. It's under pressure, 62.19 a barrel, down about 1.4%.
And that just feeds the whole deflation narrative right back on itself. If oil keeps sliding, it reinforces that negative CPI print. It becomes a self-fulfilling cycle.
It's a fascinating, if slightly terrifying feedback loop. Okay, let's transition. Heavy macro landscape, but we still have some wild moves under the surface on single stocks.
Always. Even on a flat day, somebody's making a move.
Let's start in healthcare. Massimo, ticker MASI, up a huge 34.4%. What's the story there?
It's a classic headline move. There's a Muncie firm investigating the fairness of the sale of Massimo to Danaher.
So this is all M&A speculation.
Exactly. The market is sniffing around for a higher bid. It's not about the company's fundamentals today. It's about the probability of a better deal tomorrow. The arbitrage traders love this setup.
Okay, then we've got Compass Pathways, ticker CMPS, up 42.9%. This isn't financial engineering.
No, this is science. It's a clinical catalyst. Their depression treatment met its main goal in a late-stage study. For a biotech company, that's the holy grail.
It de-risks the asset.
Completely. You go from maybe this works to this works, and the stock reprices instantly. That's your 40% jump.
Incredible. Now let's go to industrials. ZM Integrated Shipping, ticker ZIM, is up 28.7%. Now this one is interesting because we just talked about deflation and a global slowdown. Why is a shipping stock flying?
It's a bit of a puzzle. It moved on some vague financial services roundup headlines, but Zim is also a really high beta name.
So it could just be a wild swing.
It could be. Or it could be that investors are looking for tangible assets, companies that own actual ships and generate cash instead of speculative tech. It is a divergence, though. Seeing shipping up while the euro is crashing is weird.
Speaking of weird, let's hit the mystery movers. My favorite. SMX, ticker SMX, it's up 358.7%.
Wow. And you checked for news.
Checked everything. No earnings, no analyst actions, no headlines, nothing.
So that's just a pure momentum and liquidity move. In a flat market, capital gets bored and it hunts for volatility. SMX probably has a low float, a small number of available shares.
And it's just snowballed.
It's a game of high-speed musical chairs. You just don't want to be the one left standing when the music stops.
And a similar story for Atomera, ATOM, up some 1%. No confirmed catalyst.
It just highlights that there is still speculative risk appetite out there. It's just very, very targeted. It's not broad-based buying. It's sniper shots.
For sure. But there's a downside. JFB is down 42.2%.
Ouch.
The headline is Technical Indicators Flash Warning Signs for Alcohol Stocks.
That's a rough read-through for a whole sector. And it just shows that when liquidity leaves a stock right now, it leaves fast. In a market with a VIX at 21, the exit door is very, very small.
It really is a stock picker's market inside a macro storm. So, looking ahead to the close, the chop continues. What are we watching to see if this market finally breaks one way or the other?
For me, it's the rates watch. Keep your eyes glued to the 2-year at 340 and the 10-year at 404.
And why those levels specifically?
We need to see if that 10-year yield keeps rising. If it does, expect more pressure on duration assets. That means your QQQ, your NASDAQ stocks, and even long bonds, TLT, could take a hit.
And we do have more data coming tonight, right?
It never stops.
Yeah.
We have imports and exports data coming late tonight around 11:50 p.m. That'll set the table for tomorrow.
Okay, so for the next few hours, what's your final watch?
My eyes are on that curve steepening, the spread between the 10-year and the 2-year.
The recession versus reflation gauge.
Exactly. If that spread keeps widening, it means the reflation trade is gaining steam. And I'd be watching the banks, the financials. They love a steeper curve. If they catch a bid into the bell, that's a big signal.
Interesting. My final watch is just the VIX itself.
The fear gauge.
It's sticking above 21. We said the market is digesting. My worry is that digestion turns into nausea. If the VIX spikes higher into the close, say towards 22 or 23, that tells me the digestion is over and the active selling is beginning.
That would be the tell, the sign that the flat market is about to break down.
Exactly. So watch the VIX, watch the curve. It's going to be fascinating close.
Always is on a CPI day.
And one final thought to leave you with as we head into the afternoon. We talked about that 20% crash in the euro.
Yeah.
In a world where central banks are all trying to engineer soft landings, a currency move like that is like a wrench in the gearbox. If the dollar stays this strong, what breaks next? Is it emerging markets? Is it U.S. exports? We might be seeing the first crack that forces the Fed's hand, maybe even faster than any inflation print could. Just something to mull over.
That's your midday update. We'll see you before the bell tomorrow. Morgan signing off.